Hey everyone, how's it going? It's Russell here, and the Canada Mortgage and Housing Company just put out their latest housing market analysis, and they've come to the conclusion that Canada is at high risk for a market downturn, potentially risking the Canadian financial and economic systems. But the criteria they're using for this might surprise you. So in today's video, we're going to go over all of the new information that was just released, as well as how this applies to 14 different cities across Canada, and at the end, we're going to talk a little bit about whether or not this means we're actually going to see a downturn in Canadian real estate prices. But before we do, a huge thank you goes out to The Peak for sponsoring today's video. The Peak's my personal favorite newsletter covering things that matter to Canadians in an entertaining, smart, and convenient way, but more on that in a little bit. Now, the CMHC's housing market assessment is broken into 4 categories, which they use to determine whether or not a city, or even Canada as a country, is at high, low, or moderate risk. The first category is how overheated the market is, and the way they measure this overheating is through something we've talked about on the channel here before. It's called the SNLR, or the Sales to New Listing Ratio. The Sales to New Listing Ratio measures how many homes in a month were sold versus how many new homes were added to the market, giving us this ratio comparison. Now, in a perfectly balanced market, that ratio is going to be at 50%, right? For every home sold, there's another one put back up onto the market. Supply and demand is equal. Now, and it's between 40 and 60%. They sort of consider that a balanced market, even though it's not perfectly balanced at 50%. 60% plus means that it's a seller's market because there's more homes selling than there are new listings being put up. And anywhere under 40% would be considered a buyer's market where there's new homes listed at a higher rate than the amount of homes that are sold. And in their report, they say they're concerned about this sales to new listing ratio, saying that overheating continues to be detected, saying that this sales to new listings ratio, or the SNLR like we talked about, in Canada has reached a historic high of 84.1% in the first quarter of this year, but now it's dropped to 73.5%. But remember, anything above 60% is a seller's market. And they say here that despite the moderation in the second quarter, both data points for the SNLR remained above the critical threshold set to signal overheating. Now, a bunch of times in this report, you're going to see critical threshold. The CMHC essentially chooses percentages in which they deem to be sort of unsafe, making it a high risk measurement of whatever data they're looking at. So just keep that in mind for the future categories we're going to talk about here. And on this chart that measures the sales to new listing ratio, you can see that since the beginning of the pandemic, well, we've been above the CMHC's threshold, meaning that we've been staying in a strong seller's market for the entire duration of that time, above a 70% ratio. And you can also see the results of this on a city-by-city basis. Let me show you what I'm talking about here. We're going to get familiar with this chart, but when it's yellow, it means there's moderate risk. When it's green, it means it's low risk. When it's red, it means that it is high risk. And you can see here the CMHC isn't saying that any of these markets are at extreme high risk of overheating. And interestingly enough, they actually say that Vancouver, in terms of the sales to new listing ratio, has not overheated at all. This is a comparison between March of 2021 to September of 2021. This first column being March and the second being September, of course. And you can see that Toronto has transitioned from being not at risk of overheating to moderately at risk of overheating. And you can see the trend here too for most of the provinces on the east half of Canada. You can see that there is this overheating trend, and for Western Canada, largely not overheated by the CMHC standards, but they say that Canada as a whole, well, it is moderately overheated at this point. The next category they track is price acceleration, and this isn't just how expensive a home is or how much it's increased. It actually measures how quickly that house is increasing and whether or not the speed in which the home is increasing in value is accelerating. For example, if 1 year real estate prices go up 3% and then the next year they go up 6%, well, that would be a 100% increase of the growth rate of that real estate. But at the same time, if a home 1 year goes up 15% and then the next year it also goes up another 15%, well, that speed hasn't actually accelerated, that growth hasn't accelerated, so that wouldn't be measured here. And you can see that the CMHC is now detecting this price acceleration across Canada or on the national level, and you can see it right here. Since the beginning of the pandemic, this growth rate has absolutely shot up. But when we get to the city-by-city level, you can see it's a similar story to overheating, with most eastern province cities having moderate levels of risk of price acceleration, apart from Montreal, or rather Quebec, which has transitioned to low risk in terms of price acceleration. And then again, largely western provinces not having as much of that price acceleration that you may have expected, apart from Victoria and Winnipeg. But now we've also transitioned saying that Canada, while in March of 2021 we didn't really see this price acceleration acceleration on a national level, well, now that's really starting to show up. But here's where things get a little bit interesting, because the next category is overvaluation, or how overvalued real estate is in a given city. And a quick spoiler here, in Toronto and Vancouver, in the CMHC's eyes, they actually don't see this real estate as overvalued. So we're going to make sense of this in just a second, but before we do, I need to take a second to thank today's video sponsor, The Peak. Now, I've been a daily reader of The Peak for the past few months now, and it's quickly become my favorite way to stay up to date with what's going on right here in Canada. And if we take a look at the newsletter from just this morning, you can see that even the content we're covering right now, the very same CMHC report, well, they covered that right there in their email. So if you like this video, you're definitely going to like The Peak. It's written in a way that's both smart and entertaining, which is a huge contrast from the way news is normally formatted, so I actually look forward to reading it each morning. If you've ever heard of the Morning Brew, the popular newsletter in the States, well, this is a lot like that, but focused on information that's actually relevant for Canadians, and the best part is it's 100% free. I know a lot of you who are watching this video are already readers of The Peak each and every morning, but if you're not yet, make sure to click the link in the description so you can take a closer look for yourself. Once again, a huge thank you goes out to The Peak for sponsoring today's video, and a huge thank you goes out to you for clicking that link and supporting the channel. As I was saying, overvaluation is the next category for this CMHC report, and Toronto and Vancouver aren't considered at high risk of being overvalued. Now here's why. The CMHC takes a look at 3 different metrics to determine whether or not a place is overvalued, or real estate in any given city is overvalued. They first look at population, then they look at interest rates, and then they look at disposable income of the residents of that city. The CMHC calls these market fundamentals. So essentially, if a city has a high population, meaning there's high demand for real estate, low interest rates, meaning it's cheap to borrow money, and a high amount of disposable income on average amongst its residents, well then even if you're in a place where home prices on average are over $1 million, that can still be supported by these fundamentals, and you could be not considered overvalued. And based on these things, the CMHC is actually saying they're seeing an improvement in overvaluation across Canada on a national level, saying the ongoing economic recovery from COVID-19 led to some improvements in the housing market by the second quarter based on these fundamentals, saying that they saw an improvement to the fundamentals such as what we talked about, growth in the disposable income of Canadians, as well as these continuously low mortgage rates allowing people to borrow money to buy a house for super cheap. But even though these things have gotten slightly better, they're saying, hey, we're still concerned because the average home price has gone up at a faster rate than these fundamentals have been able to keep up with. That's why the CMHC believes that in general, the Canadian market is at moderate risk of being overvalued, with actually Moncton being the highest risk of being overvalued, where the population and the disposable income has definitely not been able to keep up with the increasing real estate prices. The fourth category, before we put them all together to get our final result, is excess inventories. The CMHC tracks the vacancy rate across Canada to determine whether or not rentals and new housing builds are actually getting filled up by families. This tracks simple supply and demand. If we have a situation where there's a high vacancy rate, that means there's not as much demand to buy that real estate and to have families move in. And if we have a situation like that, well, that would certainly lead to more of a buyer's market and declining real estate prices. And you can see here that in general across Canada, the vacancy rate is actually going down, or the unsold unit rate. But this actually isn't the same story across the board for Canada. There are very different stories playing out in different cities. They think that Canada as a whole doesn't have a problem with too many homes hitting the market, or excess inventory, or the new homes being built not actually being filled. We don't have a problem with that on a Canada-wide level when you look at the stats, but in certain markets there certainly is a problem. We've gone, especially in Calgary, it's gotten a little bit better between March and September 2021, but we're seeing that there's actually rather high vacancy rates here, and this could lead to making it more difficult to sell a home. Interestingly enough, also in Vancouver and Toronto, the CMHC is deeming this as at moderate risk of having excess inventories, which again, like I said, could lead to lower prices. By putting all these 4 categories together, we get a better judgment of why the CMHC thinks that in many places we could be due for a drawdown in real estate prices. They also measure this through something called market vulnerability. That's what they call this category. But without further ado, let's take a closer look at it. The way that they determine whether or not something is determined as high risk is whether or not 2 or more of these categories are at least moderate moderate, or high. So you can see here, okay, in Hamilton, Ontario, we have 1, 2, 3 categories that are at least moderate, so it gets deemed high risk. But the biggest transition is now that on a national level, the CMHC sees Canada in general at a market vulnerability high risk level, going from moderate to high risk, because again, we have 1, 2, 3 categories that are moderately risky. So the CMHC transferred this over and says, hey, the entire Canadian market, well, it's at high risk by our measurements. But just because the market is deemed to be high risk, does that actually mean that anything's going to happen? Are we going to see the major downturn that many people have been expecting for quite a while? Well, I would say that the one thing we need to watch in terms of real estate prices and which way they're going is what's happening with interest rates. There's something called the 1%, 10% rule, and it relates to how much real estate prices change as interest rates change. Now, this rule of thumb, and it is a rule of thumb, it's not an exact science, but it's something that's broadly used by many people in the real estate industry, is that when interest rates go up by 1%, we tend to see a 10% decrease in real estate prices, and vice versa. When we see interest rates going down by 1%, a 10% increase. And this is why many people believe there was such a strong impact on the real estate market at the beginning of the pandemic, because the Bank of Canada, through something called their quantitative easing program, pushed interest rates down artificially, and when interest rates go down, real estate prices go up. And as of right now, the Bank of Canada says that they're not really planning on raising interest rates until the second half of 2022. So I don't expect a Canada-wide drawback until at least 2022. But again, real estate is so market specific. And as we've seen in these charts, the stories can be far different from city to city. So of course, your individual real estate market might differ from this broad prediction. But hopefully this has given you a better idea of why the CMHC thinks what it thinks and why it's saying that the Canadian real estate market is at high risk. And I'm curious, do you agree with the methodology and how they actually put this data together? Do you think it's an accurate reading of what's happening in Canadian real estate? Let me know down in the comments. I read every single one and I try to reply to as many as I possibly can. And while you're down there, make sure to check out the Peak newsletter. A huge thank you goes out to the Peak for sponsoring today's video. If you want to support the channel, the best way to do it is to click that link and to take a closer look at the email newsletter. But with all of that said, thanks so much for watching, everybody. I really hope this video helped you out at least a little bit, and I'll see you next time.